So in this video, we'll talk about the money market and monetary policy. And just to recap, I have here the diagram with the interest rate on the vertical axis, money, the stock of money in the economy on the horizontal axis, and money supply determined exogenously by the central bank. So here as a vertical line parallel to this axis, because the money supply as determined by the central bank is independent of the interest rate, whereas money demand is a negative function, a decreasing function of the interest rate, so that the higher the interest rate, the lower is the money demand, and at the same time the money demand increases with nominal income. So that would be a rightward shift of the money demand function. And at the intersection where money demand is equal to money supply, we get an equilibrium interest rate that clears the money market, clears the financial market. So the interest rate is the variable that adjusts for the financial market to be in equilibrium. And the financial market is here expressed in terms of stocks. So we're talking about a stock equilibrium. Interest rate clears the market for stocks of money and bond. Okay, that just to recap. And I'm going to open a new page and talk now, give you 3 examples about money demand, money supply, changes in the interest rate, and monetary policy. So let's do one. The first one, I and M and MS and MD. So we have here our initial I star. So as the first example, let's assume that the monetary authorities want to reduce the interest rate. We know that the Federal Reserve, for example, targets an interest rate and adjusts the money supply in federal open market operations in order to achieve that interest rate target. That interest rate is the overnight federal funds rate that is determined in the market for overnight funds from the central bank vis-a-vis the market participants there. But we're abstracting from that complication with of between high-powered money and currency. So we're just going to talk about the money supply and money demand here. But in any case, the central bank wants to achieve a particular interest rate for the purpose of its monetary policy. In order to achieve that interest rate, it varies its money supply, supply of reserves in the economy. So in order to reduce the interest rate, let me actually use a different color. In order to reduce the interest rate, it's easy to see here that the central bank would have to increase the money supply. So with this rightward shift of the money supply curve, we're getting a decrease of the interest rate. So if the monetary authorities want I star 2 to prevail, they have to increase the money supply. How do they do that? That is what I'd like to talk about a little bit more. The Federal Open Market Committee will make these decisions and conduct these operations. But what do they do? Well, in order to increase the money supply or the supply of reserves, the Federal Reserve needs to buy bonds. So by buying bonds, the central bank hands over cash in return to the market participants, and with that increases the money supply. What though happens when the when the central bank buys the bonds. It acts as an important purchaser in this market and increases the price, and increasing the price in turn will lead to downward pressure on interest rate. We know that this is a crucial feature here. We have the inverse relationship between the price of bonds and the interest rate. So how specifically is that going about? Is that going to happen? The central bank intervenes and buys bonds and buys them from market participants. They have more cash on hand. That is the money supply in the economy, and as the interest rate then falls, the demand for money in turn rises, since it is less worthwhile to give up the comfort of cash, the comfort of liquidity, for that lower interest rate, and thus we achieve the new equilibrium. Okay, let's do a second example. How the interest rate changes with different economic conditions. Let's do it like this, and suppose that we get a shift in nominal income. So here we have MD with PY1, and here we have MD2 with PY2. So this is the rightward shift of the money demand function due to an increase in nominal income. And as you can see, we have here an initial interest rate equilibrium, but after the shift we have an intersection with the new money demand function 2, where the financial market is in this equilibrium. So here we have M2. Actually, let me not label that in detail here, but we have here that this equilibrium, we have here excess money demand, which implies excess bond supply. So the excess bond supply will lead to downward pressure on bond prices, upward pressure on the interest rate, and we can see that we will slowly but steadily in this model move up on this new money demand function to adjust money demand to the available and unchanged money supply, but at a higher interest rate. So the crucial thing is to understand what we're doing. We're assuming that we have a shock to nominal income, an increase to nominal income that shifts the money demand function. That's, in other words, we might assume that the economy grows. So we have an increase in income. Let's in fact assume that it is real income. So we have growth. The economy grows, and in response to that, the interest rate rises because we get a shift in the money demand function, and second, the upward adjustment in the interest rate in order to re-establish money market equilibrium. Let me flip back one page and outline as well here what is going on. We have an increase in the money supply, that is here, and second, decrease in the interest rate. So the money supply and the interest rate are inversely related. Monetary policy leads to this reduction in the interest rate. Growth and the growth of the economy and the interest rate are positively related. So growth of income leads to a rise in the interest rate. Now, third, the last example, we have an initial situation, initial equilibrium with I star here. Let's now assume that we have growth in this economy. So as before, we're moving from MD1 to MD2 due to an increase in Y. As we've seen, we get therefore a disequilibrium in the financial market. Here we have excess money demand. Now that would lead to upward pressure on the interest rate, but let's assume that the central bank does not want the interest rate to rise. It instead wants to accommodate growth. How does the central bank accommodate growth? Well, a central bank increases the money supply in order to hold interest rates steady at this level, re-establish financial market equilibrium at a higher money supply, at an unchanged interest rate, and at the higher income. So here increase in income would imply upward pressure on the interest rate, but with monetary policy accommodation, the money supply stock rises and the interest rate remains unchanged. So delta I equal to 0. Let me label it monetary policy accommodation. Should try to write that without typos. Monetary policy accommodation. So in these simple examples, you can see how policy growth and how policy and growth can change interest rates and how they interact with in policy accommodation.